Curious about bond opportunities for your investment portfolio? Wondering where a physician-focused wealth management firm is currently seeing bond opportunities? In today's video, Dave Kressner, who has over 2 decades of professional investing experience, will identify 2 types of bonds, municipal bonds and mortgage-backed bonds, that we currently find attractive. By watching to the end of this video, you'll learn why we find these bonds are attractive and why they might make sense for you. Spend a little time with us and profit from the experience. Well, thank you very much, Dave, for being with us today on Wealth Matters for Physicians.
Thanks so much for having me. It's great to be here.
Well, let's get right to it. In today's video, we're discussing 2 areas of the bond market that Altfest Personal Wealth Management currently finds attractive. So the first opportunity that we see is in municipal bonds. Dave, could you give us a summary, just a brief summary in terms of what municipal bonds are and why they think they could be potentially attractive in general and for some of our physicians in particular?
Yeah, absolutely, Mike. It is an interesting time for municipal bonds, and we have a slide that should help us discuss that.
Excellent.
Great, to the slide. So, as background, municipal bonds can offer a lot of value, we think, if purchased in an informed way within a portfolio. So as background with regard to what municipal bonds are, they're debt issued by states, cities, and other government entities to fund day-to-day obligations and to finance capital projects such as building schools or sewer systems. Generally, interest paid by municipal bonds is exempt from federal, state, and local taxes if you reside in the state where the bond is issued. For example, if you're a resident of New York and you buy a bond issued by a municipality in New York, the interest from the bond will be exempt from federal, state, and local taxes. This privileged tax treatment is often referred to as triple tax exemption. And as you can imagine, that exemption can be particularly valuable, particularly for people in high tax brackets in high tax paying states like New York, for example. The opportunity to lock in attractive tax-adjusted yields for high-quality bonds in your portfolio is much greater now than it was a few years ago. In the table on this page, we've illustrated the yield of AAA municipals, which are the highest quality available, with different lengths of maturity at the end of 2023 and the end of 2020. As an example, the interest rate for a 20-year maturity municipal bond jumped from 1.17% at the end of 2020 to 3.08% at the end of 2023. We can see those examples highlighted in blue on this page. When looking at municipal bond yields, given their unique tax treatment, it's most meaningful to assess them on a tax-equivalent basis. A tax-equivalent yield is the yield that a fully taxable investment would need to possess for its yield to be equal to that of a municipal investment after taxes. When you equalize for taxes in that way, you can see that these high-quality municipal bonds maturing in 20 years are offering a tax-equivalent yield of close to 7% for high tax-paying individuals in states like New York and California. While the current opportunity in municipal bonds is interesting, we really do think that it's a market that requires certain access and skill to take full advantage of it.
Before we return to the interview, thank you for watching Wealth Matters for Physicians by Altfest Personal Wealth Management, the channel which provides physicians with key investing and personal financial planning strategies. For over 40 years, physicians have relied on Altfest to help them achieve their financial independence and the future they deserve. We'd be honored to speak with you, and now back to the interview. So Dave, what you just said about municipal bonds sounds very interesting, and so it's probably whet the appetites of our physician audience. The big question then comes, how can we buy municipal bonds at attractive prices?
Sure, that's really an important question because a good investment is only a good investment if you could get it at the right price. So we have a slide that will provide a little bit more information on that. So to the slide.
Excellent.
So bonds and stocks really trade very differently from one another. Stocks of most large to medium size and even for many small companies are liquid and trade on an exchange. So if 2 investors want to buy the same stock at the same time, they'll pay the same price. By contrast, bonds trade on a negotiated basis. 2 investors buying the same bond at the same time can pay very different prices for the same investment. Generally, institutional investors that have direct access to the bond market have an advantage over your average retail investor that's accessing the market through an intermediary like a broker. We refer to this advantage, perhaps not that uniquely, as cutting out the middleman. By accessing the market in this way and essentially getting closer to it, cutting out the middleman provides several meaningful advantages. For one, when you work with a broker, you pay the broker a commission to facilitate the municipal bond trade for you. With bond transactions, the amount of the commission is often not very transparent and can be significant. By avoiding the commission, it guarantees that you'll get a lower price or a higher yield for that bond that you buy in your portfolio. In addition to eliminating the commission, with direct access to the market, you have exposure to data that can really be very helpful in making informed decisions for yourself that you might not get when you're working with an intermediary. For example, before we buy a bond as an institutional investor, we research the price history at which the bond is traded recently very closely. With that knowledge, we can make sure that the price that we're paying for the bond is at least fair, if not better than fair. By doing this, we make sure that we're getting the lowest price and the highest yield for that bond that we can in your portfolio. For these reasons, among other, we think that municipal bonds, in particular, the way that you buy the municipal bond, can make a big difference in the level of success that you achieve with the bond. For municipal bonds that we buy for our clients as well, we really think of them as the safe money within the portfolio. We want those bonds to generate an attractive level of income, but also to really be the bedrock and provide stability when the stock market wavers. We do that by focusing on really the highest of quality bonds. So I think, as I've described, when purchased with precision and expertise, we think that there's really an attractive opportunity within the municipal bond market now.
And I'll just add is that, like you said, the municipal bond market, the individual municipal bond market is very opaque. And so for the average investor, including the average physician investor, it's not something you can really do yourself unless you put a great deal of time into it to be able to know what are attractive prices for this type of bond at this particular time in the investing cycle. So that's one of the ways that we add value to our physician clients.
That's a great point, Mike. Thank you.
And so, Dave, I know that you also wanted to discuss another opportunity that we see in the bond market, which are mortgage-backed bonds. So for our physician audience, could you briefly describe what are mortgage-backed bonds and why we think there's a good why we feel there's a good opportunity in the mortgage-backed bond market right now?
Sure, absolutely, Mike. Yeah, we do think that there's an interesting opportunity within the mortgage-backed bond market now. And we do have another slide that I think illustrates a couple of points that we think will help support that rationale.
To the slide.
Very good. So a mortgage-backed bond, as the name perhaps implies, consists of a bundle of home loans that are bought from banks that have issued them. Basically, the payments that you receive when you own a mortgage bond are the interest and principal payments being made by a pool of homeowners. We think that an investment opportunity really exists within a very specific part of this broader mortgage-backed bond market. That specific part is the mortgage-backed bonds that are composed of loans that were made to homeowners that predate the financial crisis of 2008 and 2009. We view those quite favorably. The yields on those types of bonds are currently offering a very attractive yield of around 9%. 15 years removed from the financial crisis, the individuals paying these mortgages have a long history of making mortgage payments. In addition, if we think about what's happened to home prices over the last 15 years, these homeowners also have very meaningful equity in their homes. So if they're unable to make their payments, the loans are secured by a very valuable asset, their home. With other types of bonds in the market at the moment, when we look at them, we don't necessarily feel as if the return justifies the risk. But in this case, with the attractive level of yield and the safe type of investment, we really think that that is the case, that you're being adequately compensated for the risk that you're taking on. With all that said, like with the precision required to buy a municipal bond successfully, we think that buying within this narrow segment of the mortgage market also requires a high degree of knowledge and skill to navigate it successfully. So for that reason, we really wouldn't encourage individual investors to venture into this area without guidance. But we've really spent a lot of time identifying the best way to access this market, and we think that it can provide an interesting investment opportunity if you know what you're doing when making investments in this part of the market.
Well, that's all that we have for today regarding areas of the bond market that we currently find attractive. Dave, thank you very much for being with us today on Wealth Matters for Physician. I think you've given our physician audience a great deal of very interesting and practical information regarding opportunities in bonds.
Great. Thanks so much for having me, Mike. It was great speaking with you and your physician audience.
Excellent. If you'd like to discuss the information explained in today's video, receive a complimentary review of your investment portfolio or a retirement readiness analysis, or discuss any other personal financial planning area with an Altfest professional at no obligation, please contact my colleague Jesse Freeling at 212-796-8732 or by emailing Jesse at his email address, which is also in the description of today's video. If you liked today's video, please click the subscribe button below and hit the bell icon to receive notifications each time we release a new one. If you think that a fellow physician would find this video interesting or useful, please share it with him or her to help them strengthen their finances. Lastly, as always, if you have topics you'd like us to cover, like or dislike certain things that we're doing, or have any other feedback, we would love to hear from you, so please give us your comments in the comments section below. Well, that's all for now, physicians. Thank you very much for being with us in today's video, and I look forward to being with you again in our next one. Until then, be well, and remember to keep on optimizing your finances, or let us help you if you'd like.